So what has the CFPB done so far? Well, they've republished every single regulation that affects the financial services industry. They've brought all of those regulations under their wing and under their jurisdiction. They have drafted examination procedures for parties in the financial services industry. They've begun auditing and fining people who have not done things the way that they should. The CFPB has partnered with local and state governments to identify industries that need examination, or parties within the industries that perhaps need a little examination. They've extended its reach to banks, to non-banks, to payday lenders, credit card companies, and virtually any entity that extends credit or is involved in the process of extending credit. And then finally, it has issued fines in the hundreds of millions of dollars against a number of credit card companies and other financial services providers. But most importantly for our discussion today, the CFPB has authored and published 7 new rules. These are final rules, and they all came out at different points in January of this year. So this is all very new stuff. The compliance dates for these 7 new rules that are coming out, they tend to vary a little bit. We'll have a couple of compliance dates on some minor things that probably won't affect anyone in this room at all in June of this year. Most of the rules that affect us will come into play at varying dates of January in 2014. 12 months from the date the rule was published is generally when they become effective. So the 7 new rules that we're going to be talking about today are listed up here on our overhead projector. And the first one is the ability to repay and the qualified mortgage. Under this rule, the general rule is that the lender must make a good faith determination that the borrower in the transaction has the ability to actually repay that transaction and repay the loan that they're taking. That sounds very basic. It sounds like a good idea. That's what prudent lenders do anyway. The difficulty that we'll be facing in our industry is that the government and the CFPB has written specific underwriting rules as to how we're going to do this. To a large extent, the question of whether or not the borrower qualifies for a mortgage is not necessarily in the hands of the lender so much as it is in the uniform underwriting rules that the CFPB has published. And this is a double-sided print here, single-spaced. This is the ability to repay rule, and these are the regulations we'll need to deal with. Yeah. The government set out underwriting standards, and it's required for the lender to provide a qualified mortgage. It must meet certain standards, and the ability to repay must take into account the credit history of the borrower. We do that anyway, but now we're being told exactly how we need to examine that credit history. We need to take a look at the current and expected income of the borrower, and looking at the expected income of the borrower is something that's maybe a little speculative. We look at the assets of the individual. We look at the employment status, the monthly debt-to-income ratio, the DTI, and the residual income that falls over, the current debts, including alimony and child support, monthly mortgage payments as those relate to DTI, and the monthly payments of any other loan that the borrower is taking out at the same time that the current loan is being funded. So some are saying that this kind of puts an end to the stated income loan, and to an extent that seems to make a little bit of sense. So we have the ability to repay rule, and the lender must make that decision that the borrower can repay the loan. If the lender makes the wrong decision and the lender does not make that calculation correctly, then the penalties for making a mistake in that calculus are very severe. They are the full truth in lending remedies that are available to the borrower: rescission of the loan, disgorgement or repayment of all of the interest that the borrower has paid over the life of the loan, attorney's fees, court costs, a number of other financial penalties that the lender is exposed to in the event they make a mistake in that calculus. So, in order to alleviate that a little bit, the CFPB has created a concept called a qualified mortgage. And this actually originates in the Dodd-Frank Act. The CFPB has defined what a qualified mortgage is. If a number of criteria are met, including a minimum debt-to-income ratio, minimum mortgage payments, then the lender is presumed to have correctly calculated the ability to repay. So what this means, Jeff will talk about that a little bit more in depth in a little bit, but what this means to a lender is we need to dig a little bit deeper, into the borrower. We need to know a little bit more about what the borrower's not only future and past has been, but present as well. And we need to be sure that we make the right determination. Some in the industry are saying that this is going to restrict lending a little bit. The borrowers are going to be a little bit tighter than they are right now because the penalty for not making the correct decision on the ability to repay is so severe.